Hi, and welcome. You're listening to the X22 Report. My name is Dave, and this is episode 1314A, and today's date is June 23rd, 2017, and the title of the episode is Everything is in Place. The Fed Unwind is the last step. This is the warning. Let's get into the economic collapse financial news. Now, in the past couple of years, we've been seeing our politicians out there pushing the idea that everyone needs to get a raise. They need to continually raise minimum wage. And yes, this does help in the short run. The problem is that with technology and everything that is changing right now, as we keep raising the minimum wage, the corporations are going to turn to automation. They're going to move away from paying individual people. And we see this happening right now. Now, we need to go to the root of the problem. The value of the dollar continually decreases, which makes the purchasing power of the dollar decrease, which means there's inflation, which we are seeing. And this is why you continually need to raise the minimum wage. Because as you're set at a certain rate and the value of the dollar continually decreases, you can't live anymore. That's why the older generation who are on a fixed rate right now, when food goes up, when rent goes up, or anything else, health insurance goes up, they need to take a part-time job because their fixed income cannot work with the devaluation of the dollar. Now, what's happening here is that corporations right now, like McDonald's, they are turning towards like these food service ATM machines. So instead of paying someone $15 an hour, they will purchase these machines. They don't have to worry about workman's compensation. They don't have to worry about scheduling hours. They don't have to worry about someone being sick because the machine is always there. Yes, a machine will break down, but they still have other machines that are there to take your order. We're already seeing this in many of the department stores, many of the home building type of environments like Home Depot or Walmart, where you have self-checkout. And everything is turning this way, where individuals will no longer help you. You will just go to the machine and you'll do everything yourself. Because what is happening, we're at that point where it's not cost effective anymore. And this system needs to go away because, again, we could see throughout the country with all the regulations and the devaluation of the dollar, corporations, they're not staying in America. They've been leaving. And this trend is continuing. Even though Trump is out there and he's promising manufacturing is coming back, he's promising jobs are coming back, this will not happen until the reset occurs. And that's what all these promises are about, that they will come back to the U.S. if he and others can make things right here. Now, again, this is their plan. This is what they want to do. We'll have to see if it pans out. Now, today, the new home sales, those figures came out. The corporate media is out there saying that, oh, everything's bouncing back. New home sales are up 2.9%. Everything looks fantastic. Now, remember, back in April, they plunged by 11.4%. They were revised as a 7.9% drop instead of 11.4% drop. And when we look at this, we can say, well, this whole new home sale reporting, well, it kind of borders on fake news. Now, we need to remember, new home sales represent around 10% of total home sales. Now, today's report, when we look at it, and this is coming from the Census Bureau report, that new home sales increased by 2.9% over April. Yet, at the 90% level of confidence, new home sales might have been anywhere from down by 10% to up to 15%. Most likely, it's probably in the downward side. But remember, April's number was revised upward by 24,000. Now, to make matters worse, new home sales are based on contracts signed. Often a down payment and almost always financing are not yet in place. The contract cancellation percentage rate for new homes typically runs in the mid to high teens. By the way, the Census Bureau does not incorporate cancellations into its data or its historical revisions. To demonstrate how the seasonal adjustment magically transformed monthly data into many more thousands of annualized rate sales, consider this. The not seasonally adjusted number, which is presented at the bottom of the CB's report and never discussed by the media or Wall Street, is 58,000, an increase of 1,000 homes over April's not adjusted number. And yet, the reported headline, and maybe we can consider this fake news, wants us to believe that 610,000 homes were sold on an annualized rate basis, an increase of 17,000 over April. It's nothing short of idiotic, especially considering the reported average sales price was 10% higher in May versus April. Now, if today's reported number is even remotely correct, how come home builders have been cutting back on housing starts for the last 3 months? The last time starts declined 3 consecutive months was late 2008. The new home sales report for May is, in all probability, fake news. And we can see this is what they do. They manipulate the numbers to make it look like things are a lot better than they are. And we can see that they've been doing this for a very long time to keep the illusion that the economy's doing well. Now, tomorrow, Saturday, I'm going to be uploading an interview with Wolf Richter. Now, he breaks all this down, and he lays out how the economy is going to come down. He has 2 different scenarios, and one is a lot better than the other, but he doesn't know which one's going to play out. But he can see that all these bubbles, retail, and everything else, everything is completely falling apart. So tomorrow morning, Saturday, at around 8:30 a.m. Eastern Standard Time, the video should be up there. If you're on the email alert system, you'll get the email. If not, just go to YouTube, type in X22 Report Spotlight. You'll be able to listen to and watch the video, or you can come over to the X22report.com site, go to Steam It, any of these places, and you can watch the video. Now, the Fed came out and they did an annual stress test, and they said there are 34 banks that they tested. They will survive a recession. Everything looks great, and we know that these stress tests, they're pretty much fake, phony, and false. It's to make us feel a lot better since the 2008 crisis. Remember what happens each time there's a major crisis. Go back to 1929. All of a sudden, we had insurance for the deposits because no one trusted the banks because people lost a lot of money. After 2008, what happened? People didn't trust the banking system. So they said, okay, we're going to set up stress tests, plus your deposits are insured up to $250,000 to make people feel like your money is safe. Except they created the bail-in documents, which they're just going to take your money from inside the bank. So is your currency inside the banks really safe? Not really. So they did this stress test, and they're out there, parading around saying that if there is any type of recession, any type of depression, don't worry. These banks, they are strong and they will be able to ride out the storm. The problem is the Fed has a problem with the credit card debt. And this is generally the most expensive and risky debt for consumers, has now moved to the top of the Fed's worry list in the severely adverse scenario of the stress test. The projected losses for the 34 largest banks, not counting the losses of the 4,997 smaller banks, are expected to hit about $100 billion, up nearly 9% from the stress test a year ago. Now, the projected losses rose for several reasons, including that the credit card balances, well, they've grown by 5.6% from a year ago to over $1 trillion. The delinquency rate has risen to 2.4%. Now, another worry of the Fed is the commercial and industrial loans, whose balances are over twice as large, $2.1 trillion, but whose projected losses are also pegged at $100 billion. In total, the severely advanced scenario sees about $493 billion in losses for these 34 banks. Now, this number is going to be triple of what they're reporting when the losses start. Actually, they'll probably be in the trillions. And we can see that right now that this has been put together to make us believe that the banks are strong. Now, what we are seeing is that the Fed is preparing and getting ready for this collapse scenario. And this is why they're coming out with all this. Now, what's very interesting about this is that St. Louis Fed President James Bullard, he is out there saying, listen, maybe we shouldn't raise the interest rates. Maybe we should wait and see how the economic developments and Washington's policies play out in the coming quarters. Maybe we should just freeze everything to see what Trump does. Because right now, Trump has really done nothing in the economy. They passed a budget that will last until September 30th. They have the debt ceiling crisis still, which is still there. And the Fed right now is raising interest rates, and most likely certain parts of the economy have been triggered, and things are starting to rapidly fall apart, which we've been seeing. Now, remember, the Fed now is going to start to unwind their balance sheet. Now, remember, the bull markets, they're driven by new capital. You need more money from more buyers to increase buying pressure so the stock prices rise. And it looks as though globally investors are tapped out. After months of new capital pouring into the market, global equity fund inflows slowed dramatically last week. And not just a little, by a lot. Now, this is a major warning sign. Throw in the fact that the Fed is now both raising rates and draining liquidity from the markets, and there is the recipe for a serious market disruption to hit. Now, the Fed has now announced that rather than continuing to reinvest the proceeds from its maturing debt securities, going forward every month it will let $10 billion, $6 billion in treasuries and $4 billion in mortgage-backed securities come due and not reinvest the money. Put another way, going forward, the Fed will be withdrawing $10 billion in liquidity from the financial system every month. Now, this amount will increase by another $10 billion next quarter, bringing the monthly withdrawal to $20 billion, and another $10 billion the following quarter. Put simply, according to the current plan, withdrawing $90 billion in liquidity in 2017, withdrawing $510 billion in liquidity in 2018. And this marks the first time in 8 years that the Fed will not be actively providing liquidity to the U.S. markets. Will this mark the top of the latest stock market bubble? Well, we'll have to see what happens. We know that the markets are completely manipulated. We know the central banks have been buying a lot of the tech stocks, pumping all of this up. We know the Fed has been feeding the market. And again, we'll have to watch to see how this all plays out. Now, we know they're raising their interest rates. We know they're unwinding. This is a sure sign that they are getting ready for the next economic crisis that is going to happen, because they know the next one is going to be the big one. And it looks like they're cleaning house right now to make room to bring on more toxic assets, because we know these bubbles around the country, all this housing bubbles and everything else, they're all going to pop. Now remember, a lot of this market that we are in today is one gigantic illusion. A lot of these houses are owned by investment companies, speculators, hedge funds, foreign investors. They're not owned by people. So they're just going to leave them. Who cares? They're just going to say, okay, I'm out. The American people, they've been sitting on the sidelines. And the stock market, well, this has been completely manipulated. The central banks are in the market. Who's going to take the fall for all of this? Think about it for a second. When it comes down, it's going to be horrific. There's no one else to pump this back up. I mean, yes, the central bank can start stimulus once again, which most likely they will. And of course, what they're waiting for is Trump to set forth some type of policy. Because if they keep going the way they're going, and I think what happened now is they noticed that their interest rate hikes has triggered certain economic sectors and they're starting to deteriorate very, very quickly. They're saying, okay, let's hold up right now. Let's just wait a second. Let's see what Trump does, because our ultimate goal here is to blame him. Now, if you notice, he really hasn't done anything. And I think this is on purpose, because this way the central bank is trapped. If he does absolutely nothing to the economy and leaves it just the way Obama left it, and lets the central bank do everything, he can turn around and say, hey, it wasn't me. This was all you. You're the one who said, raise the interest rates. You're the one who said, I'm going to unwind my balance sheet. This is Obama's economy. And if you notice, Trump, he might seem like he's this fool that's running around doing crazy things. I think this is what he wants the corporate media to believe. I think this is what he wants the Fed to believe. I think he wants everyone to believe that this is how it is. Because, again, his greatest strength is to make everyone think one thing and do another. Remember, he's been in business for a very long time. He understands bankruptcy. He understands the game. Maybe he doesn't understand the political game, but it looks like he's getting that knowledge very, very quickly, and he did a fast one on Comey. But we can see right now he is a businessman. He knows how to maneuver around these individuals. He knows how to play with them. He understands what needs to be done. And you can see right now, this is exactly what he's doing. And like I said, there is a race to gain the narrative. If you noticed, with the case of Comey, who gained the narrative? Trump. With the case of the economy coming down, he hasn't done anything. We said this from the beginning. He will own the narrative. The Fed did everything. The Fed raised the rates. The Fed was starting to unwind. The Fed said that we have to do this. We come off of Obama's economy, who was supposed to be strong and robust. I haven't touched it. It's all falling apart. This is what he is pushing right now. They don't see it. I mean, Bullard is out there saying, whoa, wait a minute. We're moving too fast here. He's not doing anything. And you can see already they're getting nervous about what is about to happen. And that is the economy is about to come down. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared. Thanks a lot.